Alright, I think we should be recording. But yeah, today we're going to be looking at Amazon stock, ticker symbol AMZN. I'm sure everyone's heard of the company, so I won't drone on about what they do. But I guess the main thesis for this video and this trade is the infrastructure utility of the global digital economy. So yeah, kind of a little waffle, but we'll get into it and it'll make more sense as we get further into the video. But as the usual, housekeeping. So when I did the analysis, the price was trading around $210 a share. This gave it a market cap of around 2.26 trillion and an enterprise value then of around 2.3 trillion. So a bit more debt than cash. And then the FY25 revenue, which just came out a few weeks ago, came in around $700 billion. So as I said, I'm pretty sure everyone's heard of Amazon and what they actually do. So I won't spend too long on this slide specifically, but you kind of see here the business is broken down into 6 segments, which is the online store, 3P sellers, which basically means third-party seller services on the Amazon website, AWS, advertising, subscriptions, which is obviously Prime, and then physical stores, so like Whole Foods and some of the partners they have in that, and they also have their own stores, I believe, although that is tapering down. The thing I want to mostly focus on in this specific analysis then is the AWS revenue. The last decade, this has gone from basically nothing to now nearly 20% of Amazon's business. But the reason it's so important is not just because of the rate it's growing, but how profitable it is for Amazon. Whereas it's, I guess, historic business segments have been very low profit margin businesses, like obviously e-commerce and selling directly to consumers. The AWS business is a complete divergence away from that into more B2B, so business to business, and much higher gross profit margins. So you kind of see here 35% margins versus the average for the business, where in North America it's just under 7% and internationally it's just under 3%. The reason, quickly, for the difference between these two figures is just because of the amount of competition internationally, especially in Asia with like Alibaba, I think it's like Shopee and a few others. So the margins get really badly squeezed internationally. And so I guess one of the main trade theses which we'll get onto on Amazon is the fact that AWS is growing at a faster clip than the remaining segments in the business. And because of that, then the gross profit or the profitability of the business should actually exponentially outgrow the top line revenue. And so while the company, of course, will grow in the next few years, what's most important is its profitability is going to grow at a much faster rate, which while the market is expecting, I don't believe it's correctly pricing in, which we'll get onto. So you kind of see it here. I've done a key insight note where AWS is only 18% of revenue but generates 57% of total operating income. And so the real story here is the margin mix or shift towards high margin AWS and advertising as well. So in terms of the financial performance then, I think the key thing to take away here for the last few years is the so-called turnaround story, and we're kind of seeing that again play out. I think we've seen it play out over Amazon's history the last 2 decades now, but they essentially have like capex cycles. So you can kind of see here around 2021-22, they went on a massive capex spend where their net income went negative, free cash flow was negative, and operating margins were really hit. And then over the years from 23 to 25, you can kind of see the massive expansion back out of operating profit into double digits to 11%, massive increase in net income, cash flow positive, operational cash flow again really, really strong. And you kind of see a clear picture here. And I believe that's what Amazon will be going through again in 2026 to maybe 29, 30. So my own DCF model, I have them projected to actually go negative cash flow again. So like they were in 21, 22, around $50 due to the expected cash, due to the expected capex spend, which then I guess leads me on perfectly to the main thesis for this trade, which is AWS and it being the crown jewel for the company and the main growth engine. But you can kind of see some key figures here. So the run rate is around $142 billion, which is just absolutely incredible, especially when you consider where it was again just a decade ago. The backlog is around 244 billion. So again, really, really strong backlog in terms of upcoming revenue and expected upcoming revenue. They then essentially dominate the cloud market. So the cloud market is of course absolutely huge, with other players like Microsoft Azure, Google are also in there, and AWS of course have the largest share of that market at around 30%, and then we've already mentioned the operating profit margin of around 35%. In terms of why AWS matters, but specifically why in my opinion is such a strong moat for the business, it's specifically like the friction to the business or switching, for instance. So it usually takes around 12 to 24 months for like a migration cycle to happen in terms of like switching, and it's so expensive. So like, especially for big companies to switch, say, from AWS to the Microsoft Azure platform. And because of this friction and cost, most companies are very reluctant to change between suppliers and services often. There's also then the AI machine learning revenue like dynamic, which again we'll get onto later on in the thesis. So I have this estimated around contributing around 20 billion to AWS revenue in 2025. And then I projected it out to around just under 30 billion 26, which represents around 45% increase year over year. And again, if the AI capex spend continues for the next few years, I can see this either maintaining or even growing even further. And then for me, probably the most underappreciated aspect of AWS is what I'd call the Switzerland model, and that's specifically Bedrock, which is obviously Amazon's model, and it's the fact that they offer Anthropic, so Claude, they offer Meta's Llama, Mistral, and some others, and now even OpenAI, I believe, to their customers. Whereas, of course, with like Google, you're going to have to use Gemini. With Microsoft, you're pretty much locked into OpenAI. So this multi-model optionality is so underappreciated, in my opinion. Also, another moat is going to be the custom silicon. So the Graviton CPU and then Trainium chips. So this has a run rate of around $10 billion. And again, I have this forecasted to grow extremely rapidly, again, if AI capex sustains. I've also again kind of given some more technical details on the most recent Trainium 3 chip. I think the main thing to get across with Trainium is not that it will outperform the likes of Nvidia's like cutting edge chips, but rather the cost savings versus current Nvidia GPUs. Obviously, I know Nvidia are doing exactly the same with their upcoming chips, but again, it just provides the market some nice alternatives. In terms of the consumer side, then you have what I would call the flywheel, and effectively another lock-in system, which is just super effective, and one of the big reasons why Amazon is currently where it's at the moment. And that's specifically then between the advertising, marketplace, and prime segments. So what the marketplace essentially does is it brings in loads of customers into the business. As I'm sure everyone's aware, Amazon's prices are super low, and thus their margins in their marketplaces are not that great. But what that does is it gets customers in, locks them in via Prime. So obviously the Prime value prop is really high, right? So I think in the UK we pay like £95, something like that. Yeah, free next day shipping, unlimited free next day shipping, and then on top of that you also get Prime Video and some other services. And what that again inherently does is then it kind of psychologically makes members spend more. So you kind of see the figure I've plucked out here, where members spend roughly around $1,400 a year versus non-Prime members who spend around $100 to $105 per year. Now, I guess the way the sunk cost behavioral lock-in effectively works is if you're an Amazon Prime member, obviously you're going to gravitate towards the platform, and if you need something, your first thought is going to be, is it on Amazon? Can I quickly go grab it, and it's going to come by tomorrow most likely. And I guess that's something everyone knows about, but one thing I think has been underappreciated by the market is the advertising segment. So over here it currently has a run rate of around $80 billion, and I just see this rapidly growing further and further over the next few years. So my personal model has this coming in at around 81 billion in 2026. And the reason this is so effective, the ROAS, so return on advertising spend for people who want to obviously advertise on the Amazon platform. And the reason the ROAS is so much higher for Amazon versus say their major competitors in Meta and Google is because unlike Meta and Google, Amazon of course have this massive e-commerce website and platform. And one of the big differences then is that a customer can effectively see an advert and click buy now straight away, because Amazon, again, they have the infrastructure in terms of the e-commerce platform, and they already have your card details. The friction between buying something for an Amazon advertisement is super low because of that, because it's literally, like I say, like a one-click purchase. Whereas for Meta and Google, once you click into the link, you then go onto a store web page, you then see the item, the description, and then you click buy through, and then you have to put your card details in. And so the friction to buy something is much higher. And because of that, then I think in the future and over the next few years, more and more businesses who spend a lot of money on advertising are going to gravitate more and more towards Amazon and its platform. So in terms of like focusing then on the main moats of the business, we kind of gone over a few, and like I said, mainly talked about the AWS switching costs. And another super underappreciated moat that I don't really see people talk often about is actually the negative cash conversion cycle. And I think the best way to explain this to someone who doesn't have too much familiarity with accounting is that the way to visualize it is Amazon can effectively collect money within, say, 26 days, but then they can pay their suppliers in 111 days. And the reason the figure then is 48 days is because obviously it takes some time to sell an item. And so what you get is really, really strong dynamic where they've already received the money for the item, but they've not actually paid for it. And so they effectively get free money for a period of time. So that period of time then is 48 days. And so effectively then what happens during those 48 days is they effectively get an interest-free loan. Whereas if you compare it to their competitors, so like Walmart is obviously a very big direct competitor, their cash conversion cycle is a positive for 4.5 days. Which essentially means they pay suppliers and then they, like you'd expect, they then receive money and sell the item. So in terms of some catalysts then, so I know most people get quite impatient. They want to know, how they could potentially trade the stock, what's going to come up in the next few months that could impact the stock's price. For me, there's a couple big ones I'd like to flag. Of course, the 200 billion capex spend, which they announced in Q1, that just went by couple of weeks ago, which kind of tanked the stock price I say tank, but dropped the stock price around 10%, I believe. And the reason for that, of course, is because then everyone who does their DCF models and kind of buys a stock based on its free cash flow, that free cash flow essentially got squeezed because they're going to be spending all of it to increase the infrastructure. But as I mentioned earlier on in the video, this is like a typical capex cycle that we see from Amazon. So the real question is if you trust management enough to continue to, I guess, be correct. So I feel like in the video so far, we've been quite bullish and more looking towards the upside of the company. But of course, with any company, there's always some downside risk to manage and to be aware of. For me, the two most material items are going to be the FTC antitrust trial, which is in October 2026. And so for anyone who doesn't know about this, it's essentially the FTC, so the financial, I think it's like the Financial Trust Committee, or I always forget the name, but basically FTC in America, they're effectively alleging that Amazon is a monopoly, trying to break up the business and unbundle specifically Prime and FBA out of Amazon. And then on top of that, there's some more claims, but yeah, you kind of Google it and look into it for yourself. But then again, the main one is the capex return on investment and then the free cash flow compression because of it. So in my personal DCF model, I have the free cash flow to drop to around negative 50 billion. That's quite aggressive. Most people have it around, I believe, 30 to 40, anywhere between 30 to 50 billion, to be honest. But yeah, I definitely see it going negative this year. Because again, a lot of investors and specifically traders are short-term. They trade on short-term information and more quarter to quarter. In the near term, I think that could have, again, a specific downside risk to the stock. I've kind of mentioned here with Microsoft Azure and OpenAI partnership. I wrote this actually before Amazon announced their investment in OpenAI. So obviously that kind of has, I won't say gone away, but it's again lessen the risk here. And then again, Project Leo mentioned here. It's more a worry about just wasting money and burning a few $1 billion, which is never great. But again, not too material on the stock price at the moment. Cool, so going further into the bear case then and doing more of a deep dive and an actual valuation. So the core risk here then, of course, is a 200 billion capex spend. And specifically, I've kind of mentioned the NBER study, which again, I recommend to anyone who has basically any exposure to any AI stock to look into this study. But effectively, the NBER did a survey with 6,000 global CEOs to see the actual productive impact of AI on their businesses. And an incredible 90% actually said they saw zero productive impact from AI on their businesses. Now, of course, it is worth mentioning. This study was done last year, and in the last few months specifically, we've actually seen quite an explosion away from LLMs and chatbots, more into agentic AI, right? The models are now actually interacting directly onto your screen. So for example, in Excel, it will actually move cells around, write things, and actually do real work. Whereas when this survey did take place, the main function of AI at the time, of course, was mainly the chatbots like ChatGPT, Claude. So it will be super interesting to see actually if they do another one in the next few months or maybe at the end of this year, what that percentage is. But yeah, it is definitely something worth keeping in mind, that this so-called AI bubble could definitely pop at any time. I don't think it'll pop this year just because of the amount of committed spend by all the big players, but definitely in 27, if again the main number one point I make here, which is the LLMs essentially plateau, we will see significant downside for most of these companies. I'll get on to why I think Amazon is one of the better trades versus the other Mag 7s in terms of downside versus upside, risk and reward. But it's definitely something to keep in mind, and you can expect, and one could especially argue the fact that the amount of billions that has been spent on capex versus the performance coming back is kind of deteriorating in terms of like spend versus performance. And then you kind of see here the base bear case implied price from my DCF model was around $160. If you were to be a bit more prudent, the model then drops down to around $140. So that's something again to bear in mind, that the potential downside risk can be anywhere between 25% to maybe like 35%. So there's definite downside risk. But you kind of see here I've mentioned the risk to reward is actually very highly asymmetric in terms of downside risk. Again, is around maybe 25-30%, but the ultimate upside risk here I believe is at least around 100+% in the best case scenario, right? That AI continues to improve, we get AGI, not AGI that I guess most AI scientists believe, but AGI in the sense that the models become super complex, widely used, and that the need for compute power just continues to increase. That's kind of what I mean by that. So moving into the DCF model more directly then. So you kind of see here I have three cases in terms of the AGI case, which I've just explained is not real AGI but implied AGI, I guess. You have the base case and then the bear case. So with the base case, we're effectively projecting AWS to continue to grow around 20-25% year over year for the next few years, and then slowly taper off to the mid-teen percentage. So nothing too crazy in terms of growth. We're expecting Trainium adoption. So effectively, we're expecting the use and the need for AI inference and compute power to kind of relatively keep growing, but nothing too crazy, and the adoption to take place. And then the FTC issues and things like that to effectively not be material. Whereas, again, I kind of mentioned in the previous slide, but with the bear case, we're effectively expecting AI monetization to stall out, the usage of the compute or the need for it to stall out, where people realize, wait a minute, these models are plateauing, we can't just keep chucking loads of money at it. So if we were to take the base case example, the upside from the current share price is around 20%, which then if you compare it to 25% downside for the bear case, it's not that great. But then when you factor in, I guess, anywhere in between, at least, between the AGI case and the base case. So if you're effectively even relatively bullish, then the upside can go from anywhere from like 20% to 100%, right? And that then, if you do the probability weighted, so again, I've given the base case around 60%, the bear case around 25%, because I do think it is much more likely, and then the AGI case around 15%, we get a probability weighted implied share price of around $262 a share, which then gives around 24% upside. And kind of like I mentioned before, the reason I believe Nvidia have a better risk profile and a risk rewards profile to say an Nvidia or a Google, who are both I believe now trading at $4+ trillion market cap, is the fact that I feel like a lot of the potential AI benefits and upside isn't really being priced in for Amazon, whereas for Nvidia and especially Google it is being priced in, and that then allows then the downside risk to be a bit much lower versus say a Google, but then the upside risk to be much higher because again it's not been exactly priced in yet. Alright, so to end off then, we've got kind of a summary here and essentially why I believe the market may be mispriced in Amazon. So you have the consensus view that the $200 billion capex is essentially crushing margins, crushing free cash flow. So in the short term, all the DCF models are now basically chucking out a lower implied share price, which fair enough it is. But what these models and analysts I believe aren't doing is increasing say 2027, 2028 revenue and profits properly. And if they were to do that, what they then find is that the implied share price has actually most likely increased. Counterpoint to that is the fact that they are aware of that, but they just don't believe it will play out. I think that's where the crux of the position effectively lies, is that if you basically believe in the AI capex spend continuing or not, and if you believe that the money currently being spent this year will yield benefits, or if it will be effectively wasted money and burnt cash. What I can see happening is AI in its current state still being good enough, where we need more compute power, where a lot of companies will want to then kind of increase their margins by replacing humans with a lot of automation. And we've already seen that in like the software engineering segment, where again Claude Code is not perfect, but if you give quite a few competent software engineers tools like that, they can then effectively remove junior engineers and replace them with Claude Code. And then if you can prompt the software relatively well, you can then kind of get the same efficiencies and results at a far cheaper cost. And then of course that cost will then flow through to the likes of Amazon, Nvidia, and the Mag 7. Alright, I think I'll leave the video there. It went on for way longer than I thought I would, but as is the case. Of course, if anyone has any questions as normal, then of course leave them down below in the comments. Otherwise, I'll leave it until next time.